All right, folks, we got to talk about the earnings report today from DR Horton, America's largest home builder, because this was a very bad earnings report. DR Horton reported a massive 35% crash in income year over year, and they reported an insane 44% drop in their sales order backlog. Signals that this housing downturn is still getting worse and it's hitting the builders' profits. However, here's what's crazy, everyone. The stock market and housing market bulls actually love this earnings report. DR Horton's stock price right now is trading at the highest level of all time, with all the mainstream financial outlets saying that they smashed earnings and this is a sign of an encouraging housing market, which is pretty scary, everyone, because when a company reports a 35% decline in earnings and a 45% decline in their future earnings through a lower order book, you would expect the stock price to go down. But no, the stock price is going up, and that's because there's a certain mania right now still in the stock market and housing market, where people who are bullish are just looking for anything they can latch onto to justify their bullish. And ultimately, this scares me for what the downturn is going to look like when all of these people wake up to reality. Because when I look at DR Horton, America's largest home builder right now, here's what I see. I see a company that is now trading at 5 times its order backlog value. So its current market cap is $37 billion. Its order backlog is $7.4 billion in the second quarter of 2023. Now, normally on average over the last 20 years, DR Horton has traded at a 2.7 multiple to its order backlog. Now it's trading at a 5.1. What this means is that the market is valuing DR Horton stock as if it's going to grow its current order book value significantly, which is implying that there's going to be a massive housing market recovery. Not just like a little bump like we've seen in the spring. Home prices went up in March according to Zillow. Home sales have increased a little bit. No. The stock market seems to think that we're going to see a return to 2022 and 2021 home sales. That's the only way that DR Horton's stock price makes any sense right now. And if we don't see that return to 2020 and 2021 home sales, I mean, we're going to see, in my opinion, a big crash in DR Horton's stock price. We're going to see a big crash in the stock market overall, because DR Horton is not the only stock that's doing this, where the earnings are going down, but the stock price is still going up. And what really concerns me about this is that you still look at like the fundamental data on the housing market, and it looks very bad. For instance, mortgage applications to buy a house, the best real-time indicator of housing demand, it is down still 36% year over year, index level of 162, at basically the lowest level in the last 20 to 30 years. So there is no recovery in regular home buyer mortgage applications to buy a house. However, there is the perception of a housing market recovery building, because there's still a big shortage of new listings and low inventory on the market. Data from Redfin shows this. This blue line is new listings, sellers putting new listings onto the market in 2023. You can see we're down significantly from last year by about 21%. So fewer sellers putting new listings on the market means less inventory, specifically in certain markets. And so some of you are facing bidding wars right now. I hear you guys in the comments in some of your housing markets in Florida and California, and you guys are confused. Like, how is it that there's a housing crash occurring, but I'm experiencing a bidding war? It's because of the supply side. Sellers are not listing homes. It is not because of the demand side. There is no fundamental demand statistic for home buyers in America which is showing recovery. Mortgage applications, as I just showed you, are still at a 20 to 30 year low. Meanwhile, existing home sales fell by 2.4% in March. Existing home sales are still near the lowest level in 30 years. And so no, folks, there is no recovery occurring in the housing market. To see a recovery in the housing market, we need to see both mortgage applications and home sales go up significantly. We also need to see home buyer sentiment improve. None of those things have happened. The only thing we've seen is a shortage of new listings, and home builders like DR Horton having earnings reports which are bad that people interpret as being good. Now, to be fair, DR Horton in the second quarter of 2023 did do better that quarter on sales than people thought. Their revenues actually stayed pretty stable year over year at around $8 billion. But the problem comes in not with the revenues, but the cost of sales. DR Horton's cost of sales increased by over $500 million, which directly led to their $500 million reduction in net income. And so why did DR Horton's revenue stay the same, but their cost of sales went up? Well, it's simple, folks. DR Horton is offering home buyers below market mortgage rates to purchase homes. Like, I want you to look at this, everyone. If you go on DR Horton's website, you can see they have special interest rates. You can get a 5.25% fixed rate FHA mortgage with only a 3.5% down payment required, or you could get a 5.5% fixed rate conventional mortgage with only a 5% down payment required. Now, DR Horton is offering these rates of 5.25% and 5.5% when the prevailing 30-year mortgage rate is around 6.6%. So no wonder DR Horton had a short-term uptick in sales. They're allowing home buyers to buy at well below market mortgage rates, and they're subsidizing that by providing mortgage rate buydowns, which cost probably anywhere from $10,000 to $12,000 per loan that they do. And that's why DR Horton's cost of sales went up, because they're paying for these mortgage rate buydowns. Instead of lowering the price, they're paying for people to have a lower mortgage rate, and that's creating the false perception of some type of organic recovery in DR Horton and other home builders' sales. And so when you zoom out, everyone, and you look at the new home sales for builders, which according to Zonda have gone up over the last couple months, but are still at fairly, let's call it normal to lower levels historically. I mean, the bet that the builders and other people in the housing market are making right now is that they can keep the transaction volume decent by buying down the rates until the Fed pivots and then mortgage rates go down. That's basically what everyone in the housing market is banking on. And I understand it to an extent. I expect mortgage rates to go down. However, they really haven't. They're back up to 6.6 to 6.7%. So how long can this last? Additionally, we can see there's also big variation in terms of where builders are having more or less success. If we look at this data from Zonda, we can see that new home sales are down 51% in San Francisco, 46% in Salt Lake, 41% in Sacramento, 39% in Austin, 35% in Seattle year over year. So we're not really seeing a recovery at all for builders in these markets in the Mountain West areas of America. However, we are seeing somewhat of a recovery in Charlotte, in Baltimore, and Raleigh, maybe somewhat in Dallas as well, maybe in Tampa and Philadelphia. And so this fits with the broader trend that we've been seeing in the housing market, where the Mountain West and the Pacific coast of America and parts of Texas are struggling, whereas the Southeast and the Northeast are holding strong. But I'm not buying the recovery, everyone. We need to see more substantial improvement in the leading indicators of home buying demand before anyone can say that there's a recovery in the housing market. And oh yeah, by the way, all the headline economic indicators are saying that the recession is here and is going to get worse. So how are these builders going to do when the unemployment rate doubles and the foreclosure rates in their communities surge? Here's a little known fact about DR Horton from their earnings supplement. The average down payment for a DR Horton home purchase and mortgage is only 12%. That's because they have a very high share of FHA and VA loans comprising their demand. 46% of DR Horton's home purchases are FHA and VA loans for people who have very low or no down payments, basically 3 to 5%. And so as the foreclosure wave rips through America over the next 1 to 2 years, a lot of those foreclosures are going to be in DR Horton's communities, which are going to push values of DR Horton built homes down. Of course, I don't want to totally rag on the home builders in this video, folks, because they are actually being flexible and they're hustling, right? They're providing home buyers with an incentive to buy with a lower mortgage rate. DR Horton has also lowered its selling prices outright by 7% year over year. These builders are doing a lot more to entice buyers than regular sellers of homes in the U.S. housing market, who are basically saying, I don't want to cut the price, I don't want to list my home, I'm going to take my ball and go home. The builders are actually playing ball, so for that I give them some credit. However, the fact that with all of these incentives and with the builders' domination of inventory right now, that they're only able to increase home sales a little bit suggests that as the recession gets worse in 2023, these builders are going to start to have problems, and I think their stock prices are going to go down.